What you find in studying history is that depressions are mostly debt and liquidity crises that are dealt with one way or another through easing of monetary policy, which changes over a period of time. I described monetary policy 1, interest rates. Monetary policy 2, buy financial assets, print money and buy financial assets. Monetary policy 3, which we are in, is the printing of a lot of financial assets by the central bank and then buying government bonds to finance the deficit and getting money in the hands of those who wouldn't have had it through the normal financial system, essentially through that coordination. In all history, so when we go back to the 1800s and so on, there is that. And so the alleviation will happen in terms of that kind of ease. So when we think interest rates are going to hit zero and that therefore depressions last, no, they don't last, because in one form or another, and we're seeing it here today, that they will be the printing of money. Now, the value of money may not last, or they can be depreciated. But in the end, they always will ease, and you will have then that kind of reflation movement and that kind of change. So the hitting of a zero interest rate is not a hitting of a floor on the capacity of central banks to ease. If you look at the history, you've seen it happen time and time again in the same way, and it lends itself to 3 types of assets responding. The it that's happened in March 5th, 1933. Roosevelt makes the announcement about severing the dollar from gold and depreciating it and reflating it to give the banks the money that they have to pay their depositors. The same thing happened August 15th, 1971, when Nixon got on television and said that he is severing the relationship with gold and printing money and so on. The same thing happened in November 2012 with Mario Draghi making the same kind of moves. And the same thing happened on April 9th when we had the moves by the U.S. Federal Reserve and the U.S. Congress and Treasury. Same type of movements happened in 2008 when the Treasury put together and the administration and the Congress put together the TARP program and they went to quantitative easing. Those are the things that you always see happening, including times that I haven't mentioned. And when they happen, that is what happens at the equivalent of zero interest rates. Okay. It is that kind of movement and that form of easing. And that's what we're seeing. And so easing doesn't end, and the liquidity squeeze and the debt squeeze is dealt with, but it's dealt with through the printing of money that could become manifest in either the real interest rates going down, which in the case of with you have a low level of inflation and zero interest rate must be manifest with an inflation rate rising, which eventually happens, doesn't usually happen at first, or there's the depreciation in relationship to other assets. So what you're seeing right now is that reflation becoming manifest in the money that is being purchased by the Federal Reserve and government, then going into assets that are equity assets, into credit assets and so on. And that's the manifestation. Or you could see it in gold, or you could see it in the depreciation. One doesn't necessarily know at the time which is going to happen. So in 1971, when that happened, there was a big decline in real stock prices because inflation accelerated. But you do know that that combination of reflation assets will happen in a way that's very similar to the cutting of interest rates when they hit zero. I really believe that in this environment, most investors will think safe is cash, and that's tragic. So you can see that one has to think differently from one's habits. When one thinks cash is not a safe investment, it's a risky investment, that stocks and bonds are not the same as they were in the past. One has to think of the storehold of wealth concept rather than just equity returns. One has to think about balancing differently. All of these things that I'm bringing up are not commonly thought about. They're not part of the common experience of investing over the past many years. In order to understand the lessons of history and even what's more likely to take place, one has got to go back to periods that were analogous to this and to study those periods. And when we did that over the last 500 years, you could see that you don't know if you're going to see the depreciation of the value of money and the storehold of wealth. So all of a sudden that changes what you define as risk. You used to think cash as a riskless asset. Cash can be the most risky asset as it depreciates in value. And then you start to think about different asset classes and different locations. So that's what we're doing. When we think of what is the diversified portfolio for an easing that happens at that time, that's kind of a reflation portfolio. And how do you measure that in relationship to other things? Because I think the one thing that we could be confident is that the Federal Reserve and other central banks are not going to let an implosion happen without printing a lot of money. We know where interest rates are. You know that if you take a 10-year bond, you know what your return is going to be on that 10-year bond. And if you then do calculations of what is the expected returns of other asset classes, that all asset classes, and that includes private equity, it includes venture capital and so on, have very low expected returns, meaning that if you were to just hold them over the next 10 years, they're all going to have not nearly enough return, and they're going to be low. So that's a fact of life. We also know that asset classes are affected by monetary policy. So when they lowered the interest rates and did a number of other things in the past, that allowed asset prices to rise. We know a number of those things won't be able to happen in the future. But that is the character of the environment. So that the environment, it's a reality, right? Does anybody disagree that the returns of asset classes will be low from just an expected return point of view, and that monetary policy, and which is now buy financial assets and so on and print money, will be a lever that's going to have an effect on that. And so we're going to get volatility, and we have a high amount of uncertainty in that environment. So that has implications. Can we agree on that we're going to have low returns, inadequate returns generally relative to needs, with a lot of volatility around them? Can we agree that's a fact of life? I think it is. And then the question is, how do you approach it from an investment point of view? Let me describe it this way. Achieving balance, which means diversification, is more important than ever, though it will have a lower return than before. So do you want an asset class return, or do you want a portfolio of well-balanced assets? So when I look at that, I'm saying, let's say if you take a 60-40 stock bond mix, or if you take equities, or you take any one of those things. No. I think the most important thing is to start with diversifying well. Diversification of asset classes, diversification of countries, diversification of currencies, diversification, because I think that the one thing we know is that we don't know a lot, and it's not easy to necessarily time it about what is going to happen, right? So we should be given humility, and because the markets are relatively efficient in making those comparisons, it's not like one thing is necessarily better than the other, as much as we do know that some things are better diversifiers than other things to produce whatever that excess return is, that it is as stable as possible and least risky as possible to try to achieve balance. So as we look forward, what we can say is the excess returns will be lower, the premiums will be lower, but it still is better to have that diversified portfolio. It'll be a lower excess return, but it still means more stable because the individual items that make up will all have low returns, but the combination of them will make it more stable. The concentration in any one asset class, in any one country, in any one anything, history has shown is dangerous, and it is dangerous now. So when I look at it, for example, what we're seeing is reflation. We're seeing the central banks printing money and buying assets. And I do believe that they're going to continue to do that. Then the question is, does that become manifest in a way where it drives stock prices up? Does it drive the value of money down? Does it drive gold prices up? In any case, I think the big thing is that almost no investors has enough money relative to their needs. It may affect the time horizon, but if you looked at the richest investors, generally speaking, and you looked at what are their revenues, what are their expenses, and what is their saving, every individual, every company, every country has to go through that exercise. And when you look at that exercise, can you spend on your liabilities or pay out that amount of money based on the income that's coming in or the way you're going to have to tap that savings pool? You can see all around you those that are going to not be able to make it, not be able to come close in the period that we have. You have to think, what does that mean? That is going to mean that those will not default. You cannot tell most of the people that they won't get their money. That is going to mean that a lot of money is going to have to be printed because the obligation is to print that amount of money to fill those liabilities. And so that's the situation that we and most of the world are in. So when I think of investing, I want to invest in the competitive countries. I want a multi-country investment. I want a multi-asset investment. I want multi-currency investment, and I want a storehold of wealth, because what happens is wealth is not so much destroyed as shifted, from one asset class to another. There's competition of asset classes, competition of countries, competition of currencies, and so on, and they move around. And so they have to start off diversifying wealth. And then they go to where are the alpha sources, and how does one create a well-diversified mix of alpha sources? So it's the same old story.